lending. Mass Financial Services is the first management on the show. The company has reported what was a decent set of Q1 FY25 numbers. The assets under management, for example, was up around 25% in the quarter gone by. In fact, DAM Capital has a buy rating on the stock and expects the company to deliver 25% near CAGR growth. To discuss this and more, we have Dhvanil Gandhi, who's the whole-time director of Mass Financial Services with us. Mr. Gandhi, welcome to the show. Well, let's just start by talking about your breakup in terms of a book. I was looking at your Q1 numbers. Micro enterprises was up around 12.5%. You had your SME book, which was up around 23%, two-wheelers, which was up around 17-odd%. Give us a sense in terms of how exactly the rural market is doing at this point in time. Some of the lenders have indicated that there is some amount of pain, especially in the MFI and unsecured lending segment. Give us a sense in terms of what your takeaways have been and whether this kind of growth momentum is going to continue.
Hi, good afternoon. Yes, so if we talk about the asset mix for Mass, currently I think we have around 80% of the business coming from our MSME business. So we have two products under there, micro enterprise loans and SME loans. And we also have two-wheeler, commercial vehicle and salaried personal loan. So if we talk about the configuration, 80% is MSME and the rest 5-7% is from SPL and the rest is from two-wheeler and commercial vehicle. We are seeing good demand. If you look at our last quarter's MEL growth is upward of 12.5%. SME is growing robustly at more than 20-23%. So we are seeing good demand at the ground level. Yes, there has been some pain in the MFI segment. There has been some reportings from certain companies where the credit cost has gone up. But we are not directly in that working in that segment. We are working 2 or 3. Our customer segment is 2 or 3 notches above the MFI sector. So I think overall the demand is robust. We are seeing good demand in this quarter as well. The 2 months that have gone by, and we are expecting to close this quarter strongly as well.
All right. Dhvanil, first off, congratulations on being appointed as the whole-time director of the company. We've been having a lot of conversations with Kamlesh before this as well. The growth target that you've, panned out for this company is 20 to 25% AUM growth on a consistent basis. You said that you are likely to close the second quarter on a good note. Could you give us a sense of whether it'll be between this 20 to 25% range and whether it'll be at the higher end of the range or the lower end of the range?
Yes, I think it will be between that range. It will be difficult to give out exactly on how exactly the quarter will pan out. But last quarter, we had around 23-24% growth, and we expect that growth to continue in this quarter as well.
Okay. I just wanted to get back. You said that, you're not seeing any kind of pain in your MSME book at this point in time or in terms of rural segment lending. So your asset quality ratios remain the same for the entire fiscal. What are you targeting or what are you guiding for when it comes to your gross NPAs and net NPAs?
GNPA is range bound between 2.25 to 2.30 and NNPA is roughly 1.50. And our guidance has been on similar lines that our GNPA will be range bound between 2.25 to 2.5. We don't expect any adverse movement over there as of now. And even the NNPA range bound between 1.5 to 1.6% as of this fiscal. That is what our expectation is.
Right. You guys recently raised about 150 crore via debentures and you expected, your cost of funds to reduce because of credit rating upgrades, etc., which will come by as well. So a two-part question. One, what are your targets for NIMs for the remainder of this year? And secondly, what kind of capital adequacy ratio are you at right now?
Right. Yes. So we raised 150 crores of NCDs. So that is a regular affair where we keep on touching the capital markets for diversifying our resource mix. So currently, majority of our lending is through the banking channel, but we are diversifying with, and the credit rating will also help in that. Currently, the borrowing cost is around 9.8%. We expect that over a period of next 2 to 3 quarters, this will slightly come down because of the credit rating upgrade. Our rates are linked to the MCLR, so they have to reset in order for the rate reduction to happen. And
how much will that come down by? You said it's 9.8% right now. should come down in the next couple of quarters. That's point number one. And secondly, your borrowing mix. Where does it stand now when it comes to borrowing from NBFCs, borrowing from banks, and borrowing from the capital markets? If you could give us a sense.
So around 15% comes from capital markets as of now. Around 55% is from the banking channel. Rest is capital, and we have some tier 2 capital as well. So currently, we expect that the capital market portion should slowly and gradually start inching up. We also recently the capital adequacy is at 29%. We recently raised 500 crores in a QIP in June end, and that strengthened the capital adequacy, which earlier was around 23-24% to around 29% right now. And we expect around 5 to 10 bips reduction in cost of borrowing over a period of next 2 to 3 quarters, hopefully.
Okay, 5 to 10 basis points. What would that do to your net interest margins, which are above 5%?
So our NIMs that we maintain are close to 7.25%. We expect those to on between that. Between 7 to 7.5%, and ROA, return on asset after tax, to be range bound between 2.75 to 2.85% this year. That is the range that we are anticipating.
Okay, just quickly before we let you go, you've spoken about how you are extremely bullish on this entire year in your assets under management guidance, and as well as your net interest margins and cost of funds. If you had to pick out one challenge for the company, which you probably envisage in FY25, which would probably be the biggest challenge for you, what would it be?
I think maintaining the asset quality is one challenge. We are seeing some offshoots of a little bit of stress coming out in, it has started from the MFI segment, and unsecured was anyways under the radar since some time, where personal loan and all were facing certain challenges. But I think maintaining this asset quality the way that we have maintained till now, it will be important for us to be disciplined on our lending, and at the same time growing, and also a disciplined approach. That is the biggest challenge that we see as of now. But other than that, overall the macroeconomic situation looks positive for the growth that we want to achieve.
Okay, all right, Mr. Gandhi, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's Mass Financial. Let's shift focus to the oil and gas sector.